Imagine waking up to a financial bloodbath. Your portfolio is tanking, news anchors are in panic mode, and investors are scrambling. Well, that just happened. On February 3, 2025, President Donald Trump dropped a tariff bombshell that sent global markets into freefall. Welcome everyone to a ChatGPT and Grok review of what just happened when President Trump announced tariffs on Mexico and Canada. This is PiqueAI bringing you breaking global financial news via AI. If you're into real-world impact stories, you're in the right place. Today, we're dissecting a seismic event that rocked global markets. President Donald Trump's 5 p.m. tariff announcement on February 3, 2025 from his Mar-a-Lago resort in Florida. We are going to break down the details, the deep impacts. Breaking down the shockwave. What exactly happened? Ever wonder what happens when a major U.S. policy decision sends shockwaves through the global economy? Well, on February 3rd, President Trump unleashed a set of tariffs that changed the game overnight. He announced a 25% tariff on imports from Mexico and Canada and a 10% tariff on goods from China. And why does that matter? Well, these tariffs aren't just numbers on a page. They're strategic moves intended to tackle issues like illegal immigration and the flow of fentanyl into the United States. However, what really sent investors into a tailspin was the cascading impact on supply chains and global market confidence. The Wall Street Journal reported that at the opening bell of the U.S. stock market, S&P 500 futures plunged by over 1.5%, with European stocks dropping by about 1.3%. This wasn't just a minor hiccup, it was a full-blown market tremor. Why did these tariffs cause such a dramatic drop in stock prices? Let's break it down. What's really going to happen when tariffs hit? Well, first, think about this. Tariffs act as an immediate tax on imported goods. When businesses face a sudden increase in costs, they either absorb these costs or pass them on to consumers, which in turn squeezes profit margins and dampens consumer spending. For instance, automotive giants like General Motors, Ford, and Tesla rely heavily on cross-border supply chains. When tariffs spike, the cost of production goes up, and investors know that means thinner margins and reduced profitability. Could supply chain disruptions be the culprit? Absolutely. When you have companies that depend on seamless international supply chains, like Tesla with its operations between North America and China, any disruption causes a knock or ripple effect. Suddenly production slows down, delays pile up, and costs escalate. This chain reaction leads investors to pull back, selling off stocks, and sending prices tumbling. And let's not forget investor psychology. When uncertainty creeps into the market, fear takes hold. Every time you see a headline about escalating tariffs, risk-averse investors rush to safer assets, like bonds or gold, leaving equities exposed. The result? A rapid, sharp decline in stock prices. Which companies took the hardest hit? Curious about which companies bore the brunt of this tariff-induced market crash? Let's name a few and see how they were affected. Take Tesla ticker TSLA for example. With a drop of around 5 to 6%, Tesla's performance took a direct hit due to its intricate supply chains linking China and North America. Then there's General Motors ticker GM, which saw a decline of roughly 5.5%. GM's extensive manufacturing operations in Canada and Mexico made it particularly vulnerable to these tariff shocks. Ford ticker F wasn't spared either, dropping by about 3.9% as the cost pressures mounted. What about tech companies? The answer is just as severe. Nvidia ticker NVDA, a cornerstone of the tech sector, dropped by more than 5%. This decline wasn't just about tariffs, it was compounded by broader market anxieties and competitive pressures from emerging AI technologies like DeepSeek. And it's not just about tech and automotive. Constellation Brands ticker STZ, which relies on imports like Corona beer from Mexico, experienced a drop of around 4.7%. Meanwhile, industrial stalwarts such as Deere and Company ticker DE, Caterpillar ticker CAT, Aptiv ticker APTV, and Cummins ticker CMI also saw significant declines due to rising production costs and uncertainties in global trade. What are the broader implications for the economy? How do these tariff-induced market tremors affect the broader economy, and what does this mean for you? Increased costs for businesses mean that everyday products, from the car you drive to the gadgets you rely on, could become more expensive. This ripple effect, driven by higher tariffs, ultimately leads to inflation and increased interest rates. As businesses pass these costs on to consumers, we might see a slowdown in spending, which in turn could slow economic growth. Think about your own wallet. More expensive imports can mean a tighter budget for other expenses. And what about global supply chains? When tariffs are imposed, the intricate networks that power international trade start to fray. Disruptions here mean delays, higher costs, and a scramble for alternatives, all of which hurt economic efficiency and competitiveness. Now here's a critical warning. If President Trump or any political leader repeats this strategy in the future, expect a similar or even more severe market reaction. Next time we could see even deeper plunges in stock indices, a more aggressive flight to safe haven assets, and heightened geopolitical tensions that could spiral into a full-blown trade war. Imagine global markets rattled at the opening bell, with investors scrambling to protect their portfolios and companies scrambling to adjust to new cost structures overnight. It's a scenario that could have far-reaching consequences for the global economy. Remember, Mexico, after intense negotiations, deployed 10,000 National Guard troops to the border, and Canada agreed to implement measures to counteract the US tariffs. If these dynamics escalate, a tit-for-tat tariff war could emerge, further destabilizing global trade and putting more pressure on multinational companies. Your take-home points and some final thoughts about President Trump's actions on Sunday. Tariffs are economic shockwaves. Tariffs are more than just policy changes. They're immediate, potent forces that act like hidden taxes, disrupting supply chains and inflating costs across industries. Investor sentiment drives market turmoil. Uncertainty and fear of retaliatory measures can lead to rapid market sell-offs, as seen with major players like Tesla, GM, Ford, and Nvidia. These movements not only hurt company valuations but also send ripples through the entire economy. Future tariff announcements could trigger greater instability. The next time tariffs are announced, be prepared for even more aggressive market reactions, potential supply chain breakdowns, and a geopolitical chess game that might lead to a full-blown trade war. It's a wake-up call for everyone, from investors to consumers, about the interconnected nature of global economics. If you found this as eye-opening as I did, hit that subscribe button and share this video with your friends and colleagues. Stay informed, and let PiqueAI be your guide in navigating these turbulent times in global markets and tech innovations. Trust me, you don't want to miss what's coming next. Thanks for watching, and remember, in the fast-paced world of global finance and AI, knowledge is your ultimate weapon. The researchers here at PiqueAI pulled this in-depth review of the stock market impacts as a result of President Trump's February 3rd tariffs announcement leveraging ChatGPT and Grok, who were pretty equal in their effectiveness on this news and analysis piece.